You're not broke because you don't make enough money. You're broke because you keep leaking it. Slowly, silently, in places you don't even see. Fees, bad timing, panic selling, ego trades, and that one toxic belief that says, maybe I can beat the market if I just try harder. And yet, Wall Street loves that belief, because the more you chase, the more they eat. If you've ever felt confused, overwhelmed, or embarrassed about investing, like everyone else got the cheat code except you, this video is for you. In the next few minutes, I'm going to break down the brutal truth behind the little book of common sense investing by Bogle, the man who built Vanguard and exposed the entire game. You'll learn why most investors lose, even when they're right, how the market manipulates your psychology, the hidden costs that quietly steal your future, and the simple strategy that turns investing from stress into freedom. No hype, no fancy tricks, just the truth. And by the end, you'll have a clear plan, one you can actually follow when fear hits. Because the market doesn't destroy people first. It destroys their discipline. Let's fix that. Chapter 1. You're not investing. You're just gambling with better clothes. Question. Be honest. Are you trying to build wealth? Or are you trying to feel smart? Before we start, you need to know what this book really is. The Little Book of Common Sense Investing was written by John C. Bogle, the founder of Vanguard. He wrote it because he watched something ugly happen to investing. Not a crash, not a scandal, something quieter. He watched the industry turn investing into a machine designed to feed itself. He saw brokers, fund managers, and financial media create a world where your money was the product, and your attention was the bait. Bogle's main message is simple, almost insulting in how simple. Most people would do better by buying the whole market cheaply and holding it for a long time. That's it. And that's why people hate him, because his idea doesn't flatter your ego. He wasn't selling hope. He was selling reality. And reality has no fireworks. In the book, he said the central truth in one brutal line. In investing, you get what you don't pay for. He meant this. Every fee, every commission, every hidden cost is a slow leak in your future. You don't feel it today. You feel it years later, when you realize you worked for decades, and someone else collected the reward. This might sound devilish, but listen, the investing world survives because you believe you can beat it. Bogle didn't ask you to be brilliant. He asked you to be disciplined. And that's the first war. Not against the market, against your own hunger to win fast. Because the market doesn't punish stupidity first. Punishes impatience. And it does it with a smile. So ask yourself, if nobody could see your portfolio, would you still invest the same way? Or are you secretly performing? Because that's where the story begins. Not with money, with the mind. Chapter 2. You think you can beat the market, but can you beat yourself? Question. When you buy a stock, are you making a decision or chasing a feeling? You already know the truth, but you don't like it. Bogle's second blade was sharper than the first. He didn't just say fees destroy returns. He said something worse. Most professionals can't consistently beat the market, and neither can you. Not because you're stupid, but because the structure is against you. The market is not one opponent. It is millions of minds, armed with data, speed, and incentives you don't see. William Sharpe discovered in 1991 something uncomfortable. Before costs, active investors as a group must equal the market return. After costs, they must underperform. It's arithmetic, not opinion. So when you try to beat the market, you are fighting math. And math has no ego. This is where psychology steps in. Studies by Barber and Odin in 2000 found that frequent traders underperformed those who traded less. Why? Overconfidence bias. The belief that you know more than you do. You don't feel overconfident. You feel informed. But information without restraint becomes poison. Overtrading is often just anxiety in disguise. You move your money because stillness feels like weakness. Marcus Aurelius said you have power over your mind, not outside events. The market is outside events. So what is left? Your behavior. Bogle's solution was radical in its simplicity. Buy a low-cost index fund, own the entire market, hold it, reinvest dividends, ignore the noise. It sounds passive, but it requires aggression against your impulses. This is not laziness. This is strategic surrender. Sun Tzu said the supreme art of war is to subdue the enemy without fighting. Bogle applied that to Wall Street. He refused to fight the market. He became it. Let me ask you something direct. If professionals with teams, models, and inside access struggle to outperform, why do you think your late-night research gives you an edge? This is for educational purposes only. The market feeds on your belief that you are the exception. But you are not fighting the market. You are fighting your own need to feel superior. And the moment you accept that, you stop gambling. You start compounding. Quietly. Chapter 3. The silent killer in your portfolio. Costs you don't even see. Question. Have you ever calculated how much of your life you've already given away without noticing? You think risk is the market crashing. No, risk is erosion. Slow, invisible, polite. Bogle went deeper here. He exposed something most investors ignore because it's not dramatic. Costs, expense ratios, transaction fees, advisory fees, tax inefficiency. They don't scream, they whisper, and whispers compound. Bogle showed that even a 1% annual fee can eat away a massive portion of your lifetime returns. Not a small dent, a structural wound. Over decades, that 1% becomes tens of thousands, sometimes hundreds of thousands, depending on scale. This is math, not fear. And here's the psychological trap. You underestimate small percentages. Daniel Kahneman discovered in 1979 through prospect theory that humans feel losses differently than gains. But small, delayed losses? We ignore them. They don't trigger pain. They bypass your alarm system. That's why fees are tolerated. Because they are not immediate. But compound interest works both ways. It builds wealth, or it builds decay. Seneca warned that what we call small is often just slow. Let that sink in. The financial industry doesn't need to steal from you dramatically. It just needs time. High-cost funds are not aggressive. They are parasitic. And parasites survive because the host doesn't feel the bite. This might sound harsh, but you don't notice the leak because you're distracted by performance charts. You chase last year's winner. You admire the manager's charisma. You ignore the fine print. Meanwhile, your future shrinks quietly. Bogle's answer? Minimize costs. Relentlessly. Own low-cost index funds. Reduce turnover. Control taxes. That's it. Not glamorous. Not exciting. But stoicism is not about excitement. It's about endurance. So ask yourself, are you focused on returns? Or are you disciplined enough to eliminate friction? Because wealth is not just what you earn. It's what you refuse to lose. Chapter 4. The market is a mirror. Are you strong enough to look? Question. When the market drops 20%, do you see opportunity? Or do you see your identity collapsing? This is where the real test begins. Bogle didn't just talk about funds. He talked about temperament. Because markets rise, markets fall, and your mind moves faster than both. In the book, he reminded you that volatility is not the enemy. It is the price of admission. Stocks fluctuate because they are ownership in businesses, and businesses live in uncertainty. But here's the fracture. You don't react to numbers. You react to meaning. In 1987, in 2000, in 2008, panic was not about math. It was about fear spreading faster than facts. Robert Shiller showed in 2000 that markets are driven partly by narrative contagion. Stories infect investors like viruses. When fear becomes fashionable, selling feels intelligent. And you want to belong. That's the part nobody admits. You don't just fear losing money. You fear being the only one still holding. Herd behavior feels safe, even when it's wrong. Nietzsche warned that madness in individuals is rare, but in groups it is the rule. When the market crashes, your instincts scream, protect yourself. But from what? temporary price movement, or social embarrassment? This is where Stoicism demands something brutal. You separate event from judgment. A falling market is an event. Calling it disaster, that's judgment. Bogle's advice was not romantic. Stay the course. Rebalance if needed. Do not abandon the plan. This is not optimism. It is discipline under pressure. This might look passive. It is not. It is controlled resistance. Because panic selling locks in loss. Calm endurance lets time do its work. So answer me honestly, if the market fell tomorrow, sharply, would your strategy survive? Or would your emotions rewrite it? The market doesn't break you. It reveals you. Chapter 5. Time is your only real edge, and you keep throwing it away. Question: do you actually want wealth? Or do you want proof that you were right? This chapter is where Bogle starts sounding less like a finance guy, and more like a man warning you about your own nature. Because the biggest advantage you have isn't intelligence. It's time. You can hold through cycles. You can let compounding do what it does best. Grow slowly, then suddenly. But you don't, because you keep interrupting the process. You check prices too often. You react too quickly. You chase new trends like they're rescue boats. And every time you do that, you cut the roots of the tree you claim you want to grow. Bogle's core point is simple. Long-term investing works because capitalism works. Businesses grow. Productivity rises. Innovation continues. Not every year. Not in a straight line. But over time. And the deeper point? The stock market is not a casino. It is a machine that transfers money from the impatient to the patient. That's not poetry. That's history. A study by Benartzi and Thaler in 1995 found something called myopic loss aversion. People who check their investments more frequently become more fearful and take less risk, even when the long-term odds favor them. So the more you watch, the weaker you become. This is the modern curse. You're over-informed and under-disciplined. Constant monitoring is not awareness. It's self-inflicted stress. Bogle wanted you to understand this. You don't need to predict the market. You need to survive it. Stoicism teaches that the wise person does not demand certainty. He builds resilience. So ask yourself, are you building a plan that depends on you being calm, or a plan that collapses the moment you feel fear? Because the market will test you, not once, over and over. And if you keep grabbing the steering wheel every time the road bends, you will crash the car you were meant to drive for decades. Time is your edge. Stop trading it for emotion. The video is half finished. If you like the video, be sure to comment and watch the next steps. Chapter 6. Dividends, Growth, and the Illusion of Control. What are you really owning? Question: when you buy a stock, do you feel powerful? Or do you actually understand what you own? Let's slow this down. A stock is not a ticker symbol. It's not a green arrow. It's a claim on real businesses, factories, software, labor, risk. Bogle kept reminding you of something simple but deep. In the long run, stock returns come from two sources: dividend yield and earnings growth. Speculation, the guessing game of price changes, fades over time. You can't control valuation swings. You can't control investor mood. But you can understand what drives real return. Dividends are not gifts. They are profit distributed. Earnings growth is not hype. It is business expansion, productivity, innovation. Everything else, the daily noise, is narrative. Benjamin Graham once separated investment from speculation by one line: investment rests on analysis and safety of principle. Speculation rests on price movement. And most people drift between the two without noticing. This might sting. Chasing high dividend stocks without understanding payout sustainability is not strategy. It's yield addiction. Companies can overpay dividends to attract attention. They can borrow to maintain appearance. That collapses later. Growth stocks? Same trap. You project stories onto them. You imagine infinite expansion. But businesses live in cycles. This is where Stoicism grounds you. You don't worship dividends. You don't worship growth. You accept that total market return reflects collective enterprise. Bogle's answer was elegant again. Own the whole market. Let winners and losers offset naturally. Don't pretend you can consistently pick tomorrow's champion. Because here's the deeper question. Do you want control, or do you want results? The desire to pick the right stock is often ego disguised as research. Owning the total market removes that illusion. It forces humility. And humility in investing is not weakness. It's structural strength. So look at your portfolio. Are you owning businesses? Or are you owning stories that make you feel clever? There's a difference. And your future depends on which one you choose. Chapter 7. Asset Allocation. The only decision that actually matters. Question. Do you know what kind of pain you can actually endure before you start lying to yourself? This chapter is where the book stops being about Wall Street and starts being about your character. Bogle made a point that quietly destroys most investors. Your long-term outcome is driven less by which funds you pick, and more by how you divide your money between stocks and bonds. That's asset allocation. Not sexy, not exciting, but it's the steering wheel. Stocks are growth. Higher reward, higher volatility. Bonds are stability. Lower reward, lower volatility. And here's the trap. People choose allocation based on optimism, not based on reality. They say they're long-term. They say they can handle risk until the market drops. Then the truth arrives. Your risk tolerance is not what you claim. It's what you do when you're bleeding. This isn't a finance issue. It's a psychological one. A study by Weber, Blaze, and Betts in 2002 found that risk-taking varies by domain. People who are brave in one area can be fragile in another, meaning you can be confident in life and still panic in markets, because money touches survival, and survival triggers the animal brain. So Bogle's advice was grounded. Pick a stock/bond mix you can hold through a crisis, not one that looks impressive in good times, because the best portfolio on paper is useless if you abandon it under pressure. Stoicism fits perfectly here. The wise person doesn't choose what feels heroic. He chooses what he can sustain. He doesn't worship intensity. He respects endurance. This is where many people ruin themselves. They go too aggressive. They get punished. They sell low. Then they become conservative forever and miss the recovery. It's not just loss. It's psychological scarring. So here's the real question. If your portfolio dropped 40% and stayed down for 2 years, would you hold? Or would you start bargaining with reality? Because allocation isn't about returns. It's about behavior, and behavior decides everything. Chapter 8. The industry is not your friend. It's a business. Question. Have you ever asked yourself who profits most from your investing activity, you or the system around you? Let's strip this clean. Bogle was not anti-capitalism. He was anti-extraction. He saw that the financial industry had grown larger than the value it delivered. Funds launch every year. Strategies multiply. Commentators shout daily. But ask yourself, has complexity made you calmer or more confused? The industry earns when you move, when you trade, when you switch funds, when you panic. Stillness does not feed it. Activity is sold as intelligence, but activity generates fees. In 2016, French published research showing that the aggregate cost of active investing is a direct subtraction from investors' total returns. This is not scandal. It is structure. The system doesn't need to cheat you. It only needs to be expensive. And here's the psychological twist. Choice overload. Iyengar and Lepper discovered in 2000 that too many options reduce satisfaction and increase paralysis. The more funds you see, the more you doubt yourself. So you outsource judgment. You follow experts. You chase ratings. You buy what is trending. Because certainty feels safer than simplicity. But simplicity threatens professionals. A low-cost index fund held for decades does not require constant advice. And that is uncomfortable for an industry built on motion. This might look cynical. It's not. It's structural awareness. Sun Tzu said you must know the terrain before entering battle. The terrain of investing is layered with incentives. Some align with you, many don't. Bogle's quiet rebellion was this: reduce dependence on advice that profits from your confusion. Keep costs low. Keep turnover low. Keep strategy simple. This is for educational purposes only. You are not required to distrust everyone, but you are required to understand incentives. Because the market is not just numbers. It is institutions, and institutions protect themselves first. So ask yourself honestly, are you investing, or are you feeding a machine that thrives on your uncertainty? Chapter 9. Stay the course, or admit you never had one. Question: when pressure rises, do you follow your strategy, or do you negotiate with fear? This is the chapter where everything converges. Low costs, broad diversification, asset allocation, time, all useless if you abandon them when emotions spike. Bogle's most repeated command was simple: stay the course. Not because markets are kind, but because they are indifferent. They don't care about your mortgage. They don't care about headlines. They don't care about elections. They fluctuate. They recover. They move on. The S&P 500 has survived wars, recessions, political chaos. It fell hard in 2008. It recovered. It crashed in 2020. It rebounded, not because of optimism, but because businesses adapt. Yet you don't fear decline. You fear uncertainty. Studies by Hirschleifer in 2001 showed that investors overweight recent information. Recency bias. What just happened feels permanent. So when markets fall, you project collapse. When they rise, you project infinity. Both are distortions. Changing strategy during chaos is usually emotion wearing a rational mask. You tell yourself it's risk management. Often it's discomfort avoidance. Marcus Aurelius wrote privately to himself, not to escape chaos, but to remain steady inside it. That is the skill here. Staying the course does not mean ignoring reality. It means committing before the storm, so you don't redesign your ship mid-ocean. Because if you redesign during turbulence, you introduce new errors. You trade one uncertainty for another. Let's be direct. If your plan only works in good markets, it was never a plan. It was a mood. This might feel harsh, but discipline is not proven in comfort. It's proven when you want to quit. So answer this: did you design your strategy in clarity, or are you rewriting it in panic? Because the market rewards consistency and punishes improvisation born from fear. Stay the course, or admit you never chose one. Chapter 10/10. Wealth is character. Money just reveals it. Question: if your net worth doubled tomorrow, would you become wiser or just louder? This is the final layer. Bogle didn't end with tactics. He ended with philosophy, because investing done right becomes boring, and boredom forces you to confront something deeper. Who are you without the drama? If you follow his path, low-cost index funds, disciplined allocation, long-term holding, something strange happens. You stop obsessing. You stop refreshing. You stop performing. And now you face silence. That silence is uncomfortable, because many people use investing as stimulation, as identity, as proof of intelligence. But Bogle's framework strips ego from the process. You become average by design. And paradoxically, that average becomes powerful. Nietzsche spoke about the will to power, not as domination over others, but mastery over oneself. In investing, self-mastery is the edge. Not prediction, not brilliance, restraint. There is another danger here. Wealth without philosophy becomes appetite. The more you gain, the more you want to risk. More leverage, more speculation, more complexity. Success can destabilize discipline. History is filled with investors who built fortunes slowly and lost them chasing excitement. Stoicism teaches this clearly. External gain is indifferent. Character is not. Money amplifies your habits. If you are patient, it rewards patience. If you are impulsive, it magnifies destruction. This is for educational purposes only. The goal was never to beat anyone. The goal was freedom. Freedom from unnecessary stress. Freedom from manipulation. Freedom from your own restless ego. So here is the final question. When the market no longer controls your mood, when headlines no longer shake your plan, when compounding works quietly in the background, who do you become? Because in the end, common sense investing is not about outperforming the market. It's about outperforming your impulses. And that is a lifelong discipline. Thank you very much for watching my video, and please like and subscribe to my channel.